Hey, it's Darius, and congratulations to I-75ers who let me know that they passed the CPA exam this month. See the green check marks? That means they're done. No more CPA review for them. But what about you? Are you connecting well with the material that you're using? You can still pass. You just might need to get on the right road. Go to i75cpareview.com and get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll save a spot for you on next month's list.
Requests have been coming in for a standard costing sim with overhead variances that include journal entries. We got Stillwell Manufacturing applies overhead based on direct labor hours, and each unit produced should take a half hour of direct labor. So not 2 hours of labor, not 1 hour of labor, but each unit produced should take a half hour of direct labor. In the month of March, 900 direct labor hours were used to produce 1,600 units. The standard variable overhead rate is $1.25 per direct labor hour. The actual variable overhead rate for March turned out to be $1.40 per hour. And that's what they would do on a sim like this, pour on a lot of facts and figures, many of which would not be relevant for any particular question. Here's question 1. How much was the actual variable overhead cost for the month of March? So what was spent on variable overhead for the month of March? Well, they tell us that the actual overhead cost turned out to be $1.40 per hour. And if you multiply that times the actual number of direct labor hours worked for the month, 900 hours they told us were worked, you would get what was spent on variable overhead for the month of March, $1,260. That's not a variance, that's the actual amount of variable overhead cost. And what we would do with that is make a journal entry debiting factory overhead, or what they call factory overhead control, and crediting cash, because that represents what was spent on variable overhead for the month of March. So make a note, if they ask you what was spent, you're going to need a journal entry. And the factory overhead account, or what they call factory overhead control, is debited for actual costs. So we're going to start to prepare this T account for factory overhead control, and the first thing we're going to do is put this debit of $12.60 in for the actual variable overhead cost. We're going to have actual fixed overhead cost, that's going to be debited also, and then when we apply overhead, we're going to credit this factory overhead account. We'll apply variable overhead, we don't know how much yet. We'll apply fixed overhead, but we don't know how much yet. We're just getting started. All we know so far is the variable overhead cost is $12.60, and that's a debit to the factory overhead control T account. And that's because we debited factory overhead control and credited cash for the amount spent on variable overhead. And this whole sim is going to be based on the same fact pattern unless otherwise noted. Question number 2 asks, how much is the variable overhead spending or variable overhead rate variance? Which means, did we spend more or less than what we budgeted on variable overhead? And variable overhead is based on, how do they apply it? It's based on direct labor hours. And how much did we actually spend versus what was expected to be spent? Well, in the prior question, we learned that $1,260 was actually spent on variable overhead. And that's based on the 900 actual direct labor hours worked that they told us about, times the actual overhead rate of $1.40. That gave us the $12.60 that we actually spent. Now, how much was budgeted to be spent on variable overhead if 900 direct labor hours were worked? Looks like we should have spent $1.25 for every direct labor hour, or $1,125 should have been spent. So if we spent $12.60 and we should have spent only $11.25, then our variable overhead spending variance is unfavorable by $135. And we immediately know it's unfavorable when the actual overhead rate of $1.40 is greater than the standard overhead rate of $1.25. We knew it was going to come out unfavorable, but we didn't know how much until we multiplied the difference in the two rates times the 900 actual direct labor hours that were worked to make 1,600 units. It's a spending variance. So the focus of the variance is what's inside the parentheses, the actual overhead rate compared to the standard overhead rate. And since it's a spending variance, the outside of the parentheses, what's outside the parentheses is the actual quantity. So 900 actual direct labor hours that were worked times the difference in the two rates will give us the variable overhead spending variance or the variable overhead rate variance. You got to know that they're the same thing. The exam could call it variable overhead rate variance or variable overhead spending variance. It's the same thing. Did we spend more or less on variable overhead than we budgeted, which is direct labor hours? So now we know our first variance, variable overhead spending, is $135 unfavorable. And you might be wondering, how many total factory overhead variances are there? There's going to be 4, and we just did one of them because there's 2 for variable overhead and there's 2 for fixed overhead. So keep track with me. Variable overhead spending is so far $135 unfavorable because what we spent on variable overhead, $1,260, compared to the budgeted variable overhead of $1,125, that's where we got $135 unfavorable. So I want you to do 2 things with me as we go through the sim. Make the T account, keep track of everything that's been actually spent for overhead and when we apply overhead. And then when we calculate a variance, I want you to fill it in. So far we have 1 variance filled in, variable overhead spending variance. We've done 2 questions so far. The first question asked, how much did we actually spend on variable overhead for the month? And we said what we spent on variable overhead resulted in a journal entry for us. Remember what that journal entry was? Debit to factory overhead control and credit to cash for what was actually spent. The second question was based on what we spent on variable overhead, and it asked how much is the variable overhead spending variance. And that doesn't result in a journal entry, but it allows us to keep track of the 4 overhead variances. So far we have 1 out of 4. Now our goal is going to be the variable overhead efficiency variance. And this is going to have less to do with what was spent and more to do with whether we were wasteful with the use of labor hours. Did we use more labor hours than we should have or less for the given level of production? So here's question 3. How many more hours of direct labor was used in March than budgeted? So based on the same facts, unless otherwise indicated, Stillwell Manufacturing applies overhead based on direct labor hours. Each unit produced should take half an hour of direct labor. In the month of March, 900 direct labor hours were used to produce 1,600 units. Okay, so if 1,600 was the actual level of production for March, and each unit produced should only take half an hour of direct labor, then they should only have used 800 hours of direct labor to produce 1,600 units. And how many direct labor hours were used? 900 were used. So how many more hours of direct labor was used than budgeted? 100 hours more. And that's a sign of inefficiency. So the answer to question 3, how many more hours of direct labor was used in March than budgeted? 100 hours more were used. And that's a sign of inefficiency, because to make 1,600 units should only have taken 800 hours, because it tells us each unit produced should take a half an hour of direct labor. So if we use 900 hours where we only budgeted to use 800, we used 100 hours more than we should have, and that's a sign of inefficiency. So when we get to the variable overhead efficiency variance, we know it's going to be unfavorable. So we used 100 hours more than we should have. Do we need a journal entry for that? No. Is that a variance they just asked us about? No. Just a heads up. We're always anticipating the next question, right? That's the I-75 difference. And we're anticipating the next question to be, calculate the variable overhead efficiency variance for March. And it's going to be based on the 100 extra wasteful hours that we used to produce 1,600 units. 1,600 units were produced. Each should take half an hour of labor or 800 hours. But since 900 hours were worked, the extra 100 hours times the standard variable overhead rate given in the facts at $1.25 equals the variable overhead efficiency variance of $125. So variable overhead efficiency variance It's not a spending variance. The focus of the variance is what's inside the parentheses. We're comparing not $1.25 to $1.40 this time. That was the spending variance. Now we're comparing the 800 hours that should have been worked with the 900 hours that were worked, that difference of 100 hours, times the standard variable overhead rate of $1.25. So this $125 unfavorable variable overhead efficiency variance is based on the hours worked, the actual hours compared to the standard hours. The focus of the variance is what's inside the parentheses. For efficiency, we're focusing in on the hours worked. What should have been worked to make 1,600 units? 800 hours. What was actually worked to make 1,600 units? 900 hours. We have 100 wasted hours. Times what's on the outside of the parentheses for an efficiency variance? The standard rate. So the standard rate of $1.25 times that $100 of wasted hours gives us $125 variable overhead efficiency unfavorable. Do we need to make a journal entry for this? No, because it's a variance. We didn't spend money. We didn't apply overhead. We just calculated a variance. You keeping track of your variances with me? The first one was variable overhead spending, 135 unfavorable. Now we have variable overhead efficiency, 125 unfavorable. At this point, our overhead variance is 260 unfavorable. But we're not done, because now we have to move on into the fixed overhead variances. There's going to be 2 of those. But we're at the halfway point now. There's only 4 factory overhead variances, and we have 2 of them done. What we're going to do now before we go on to fixed overhead is we're going to apply variable overhead. I thought we did that already. No, we didn't apply variable overhead. We kept track of what we spent, $1,260. Now we're going to apply variable overhead. Let's calculate how much variable overhead is applied. And that's going to result in a journal entry that's going to credit this factory overhead control account, and it's going to debit work in process inventory. So question 5, how much variable overhead was applied in the month of March? Well, variable overhead is applied to production using the standard hours allowed for what was produced. What was the actual level of production again? 1,600 units. What's the standard hours allowed for that? 0.5 each, or 800 total hours. So we're going to apply variable overhead to production, the 800 hours that are the standard hours allowed, times what was the standard rate? $1.25. So $1,000 of variable overhead will be applied to production in March, and that will result in a journal entry for us, a debit to work in process inventory, and a credit to the factory overhead control account. Remember, when we actually have costs incurred, we debit factory overhead. But when we apply factory overhead, we credit factory overhead and debit work in process. Now grab a hold of that T account that we started when we determined earlier that we spent $1,260. Actual variable overhead cost was a debit to factory overhead. When we apply factory overhead, we credit the factory overhead account for $1,000. And look where we are right now in the factory overhead T account. We have $260 left on the debit side. We spent $1,260. We applied only $1,000, so we're under applied by $260, and that's considered unfavorable, that we spent more than we expected to spend. Now, why does that $260 sound familiar? What else was $260 so far? Oh yeah, our variances. Our variable overhead spending variance combined with our variable overhead efficiency variance adds up to $260 unfavorable. Is that a coincidence? No. That's supposed to happen. Because when we get all done with these variances, whatever we get is going to equal the balance in our factory overhead T account. And right now it equals. 260 under applied means we spent 260 more than we applied to production, and that's considered unfavorable. You'd rather spend less than spend more, but it is what it is. We spent more than we applied. That's unfavorable. And then when we look at the variances so far, our combined variable overhead variance is 260 unfavorable. So we're halfway done. We got to move on to fixed overhead variances, and there's 2 of those.
And if you're finding this I-75 sim on bar helpful, and you want to see the rest of it and more videos like it, go to i75cpareview.com and get yourself on the right road. Get on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll leave a link in the description.